Hi, everyone. Thank you for joining us for today's webinar, Capital Access and Women's Founders, Progress, Gaps, and What's Next. Today our panelists will take questions at the end of the sessions. So if you have anything that you'd like to ask, please add it in the QA session. For now, I'll hand it over to you, Ayo, to get us started.
Thank you, Amy. Hello and welcome to Alberta Innovate Capital Access and Women Founders webinar. Today we'll be focusing on progress, gaps, and what's next. My name is Ayo Ayeleye. I'm the Executive Director of Entrepreneurial Capital here at Alberta Innovate. And I would like to start things off today with a land acknowledgement. We acknowledge the many First Nations, Métis, and Inuit who have lived in and cared for these lands for generations. We're grateful for the traditional knowledge keepers and elders who are still with us today, and those who have gone before us. Alberta Innovates respectfully acknowledges that we are situated on traditional territory of the Treaty 6, Treaty 7, and Treaty 8 First Nations, home to Métis settlements, the Métis Nation of Alberta, comprising Districts 5 and 6 in Calgary, 8 in Devon, 9 and 10 in Edmonton, and District 12 in Vegreville, within the historical Northwest Métis homeland. We respect the histories, languages, and cultures of First Nations, Métis, and Inuit, whose presence continues to enrich our vibrant community. Before I hand things over to Ariel Land of Movement51, who will be moderating today's webinar and will be your host for today's session, I would like to take care of a few housekeeping items. Today's session will consist of a discussion followed by some time for questions at the end. But feel free, while the conversation is going on, to use the Q&A function to ask your questions, so you can put your questions in there throughout the presentation. We'll work to get through as many as we can right after the presentation is done. Thanks again for spending some of your afternoon with us this afternoon. We're looking forward to a really insightful conversation and hope you enjoy the webinar. So I'll hand it now to Ariel.
All right, thank you so much, Ayo, and welcome everyone to today's discussion. We're really excited to be here and very grateful. We are entering 2026 in a capital market that looks very different from the 2021 peak. Capital is available, but it's selective, concentrated, and increasingly structured. We're seeing that deal volume remains below peak levels. Liquidity pathways are constrained. Investors are writing fewer but larger checks with greater diligence and discipline. At the same time, I'm happy to share that women entrepreneurs in Canada are starting and growing businesses at record levels. Majority women-owned firms now represent nearly 1/5 of Canadian businesses. Policy investment such as Women Entrepreneurship Strategy and related initiatives has expanded capital vehicles and financing tools. We're also seeing more women-focused funds and acquisition strategies entering the market. And yet, structural gaps remain. Women-founded companies still represent a small share of venture-backed founders. Average loan and equity amounts, they're smaller. Access to large growth rounds, they continue to lag. So I'm excited to bring you today's conversation about the intersection of these two realities, a more disciplined capital market and an evolving but uneven landscape for women founders. Today's conversation brings together an ecosystem leader from Movement51 and an investor from The 51, and they will examine how Canada's capital landscape is evolving and what that evolution means specifically for women founders seeking to start, scale, and lead high-growth companies. So welcome, Emily Smiley and Courtney Dragani. I'd like to start off with you two briefly introducing yourselves. Emily Smiley, can we start with you?
Absolutely. Hi, everyone. I'm Emily Smiley. I'm Executive Director at Movement51. If you're not familiar with Movement51, Movement51 is a national nonprofit delivering best-in-class education in early-stage investing and business funding. Our programs are built to focus on financial fluency, strategic readiness, and decision-making power that women need to raise capital, to invest with purpose, and to lead confidently, whether their role is as a founder, an investor, or an economic decision maker. I'm glad to be here today.
All right, Courtney, over to you.
Hello, everyone. I was going to say, so nice to see so many faces on this, but that's so nice to see all the faceless individuals who have spent their afternoon with us anyways. I am the Chief Growth Officer for both the 51 and Movement 51, so I have the great privilege of working alongside Emily and Ariel, developing out what our educational programming looks like for both the investor and the founder audiences, as well as on the 51, our financial platform and venture fund, building out what our growth strategy looks like there, partnerships, what the products are that we bring to market, maximizing the fund sizes that we build through individuals coming on board so that we have more capital to deploy across women-led innovation, and then leading our membership strategy, events, marketing, sales, that side of the business as well. So very excited to be here today.
All right, thanks, team. Let's get started. I want to start broadly here. As I mentioned, capital is available, but it's selective and concentrated. We're seeing larger deal sizes, fewer transactions, and liquidity remains constrained. So my question to the two of you, and I'll hand it over to Emily to start. I'm curious, how does the macro environment shape access to capital overall?
Yeah, thanks, Ariel. I think there's no doubt that it does shape the environment. And right now, today, one of the biggest shifts that we've seen in the last few years has been the move from what I would have called capital abundance to something probably more aptly called capital discipline. So if we think back to 2020 and 2021, in that environment, we were seeing investors deploying capital at really high rates and high speeds. A lot of decisions were being driven by volume, aimed at placing as many bets as possible to see what could perform. But today, that dynamic is very different. We're seeing investment decisions as being much more conviction based. So investors are back to spending more time, as they were pre 2020, on diligence and focusing on companies that demonstrate strong fundamentals. So that means now when investors are looking at opportunities, we're seeing greater emphasis and focus on things like the revenue quality and durability of the company, the margin profile, their governance structure, and the capital efficiency, especially of those companies. We're seeing, and CBCA has reported this as well, the deal volume is lower, but the deals that are happening are often larger minority investments. And so the capital tends to concentrate in companies that investors believe really can perform, even as liquidity cycles are long and may continue to stay longer than expected.
Thanks,
So
Emily.
I think, sorry to add one more thing, just that I think I'm often asked if we're seeing a contraction of capital, are there fewer investments? Is it possible to be fundraising right now? Can I possibly be successful? And rather than it being a contraction of capital, I think it's more appropriate to say that we're seeing a recalibration of how that capital is being deployed.
Great. Thanks, Emily. And great overview. I'm curious to hear the investor side. Courtney, do you mind sharing with us what you're seeing?
Yeah, I completely agree. And I mean, certainly our team managing both the deployment of a fund and raising a fund at the same time. What's really driving their purview and their perspective is that there is a slow exit market right now. So there are prolonged holding periods, and really managing the liquidity is like a top concern that they're chasing. And so some of the data shows, only 7% of Canadian unicorns exited in 2024. And that means that from a fund management perspective, they are forced to look for secondary options to exit. And so it could be faster but smaller and safer deals in order to manage distributions back to their LPs so that the LPs then have capital to reinvest back in the system as well. We have seen, certainly that decline in investment opportunity, which doesn't mean that capital has completely dried up. But Emily, in agreement with you and building on that point, it's just there are increased expectations, I would say, around deal structuring and what that looks like. So there may be more of a push now for preferred equity than there was historically, more protective provisions that investors are looking for to make sure that they have coverage on the downside as well. And then more of the milestone-based financing too. And I would say that that is not unique to the Canadian market. I mean, certainly seeing that south of the border as well, but investors will make the capital available, but they will also say, show me that you can achieve the plan that you have articulated, and I will release funding in tranches. And once you achieve those milestones based on the business plan that we've agreed to and kind of predicates this investment, there will be more coming, but they're just expecting, I would say, a heightened level of sophistication in your ability to execute against what was the basis of their investment decision. And so agreed, I wouldn't describe it necessarily as a contraction, but a recalibration. And that does change the bar for entry in terms of getting into the market and getting that financing, just that you're demonstrating that level of sophistication that they will also expect from an investment perspective that you're able to demonstrate.
Thanks, Courtney. And so what I'm hearing is that capital hasn't disappeared, it's more disciplined. The bar is higher, diligence is deeper, investors are concentrating capital into companies that demonstrate strong fundamentals and that resilience. So that recalibration, as you mentioned, is shaping how founders and investors approach the market today. All right, let's shift it a bit here. And talk about what has meaningfully improved for women founders. Where have we seen these meaningful shifts in capital pathways for these female founders? I'll start with you, Emily.
Yeah, thanks, Ariel. I think, it's easy when we talk about women founders to default to many of the more negative stats and not to really look at the progress that's been made and what we're seeing happen. And in the Canadian ecosystem, I really do think we have been seeing meaningful progress, especially in terms of how capital pathways have been diversified for women founders. Ariel mentioned earlier the women entrepreneurship strategy, and I think policy initiatives like the women entrepreneurship strategy have really helped to expand our capital landscape. We've seen across Canada growth in new debt tools available to women entrepreneurs. We've seen blended finance models, and we've seen new capital vehicles that are designed to reach founders who historically have been the ones that have the fewest financing options when it comes to growing a business. We've also, and I think very importantly, been seeing an increase in women-focused funds, as well as more interest in acquisition-oriented strategies as a pathway to building and scaling companies. And so when it comes to the capital ecosystem for women founders, it's very easy for me to confidently say that I believe it's broader than it was even 5 years ago. What's really valuable here is that founders are not only relying on traditional venture capital, though we need it, it's not the only pathway forward anymore. There are more pathways to building scalable businesses, and that diversification is a really positive development for the ecosystem, and especially for women founders based on a lot of the data we've seen on how they've been building businesses and growing them.
Well, that's encouraging to hear. Courtney, what are you seeing as meaningful shifts?
I think there are several things that are kind of notable to observe. I think one is that in terms of the data that we provide back, particularly to our institutional LPs or our partners, they are expecting a heightened level of detail and rigor around disaggregated reporting. So they're no longer just saying, tell us about what's happening across the entire portfolio, but gender and the influence of gender is a piece of data that they are now honing in on and saying that we want to understand the differences about what it looks like for who is running the company, not only in a CEO position, but in terms of the leadership suite, in terms of the board of those companies as well. And so they've realized that it's a meaningful piece of insight for them to collect out of what's happening in the ecosystem, which is promising. I would say that the limited partners into our funds, particularly from an institutional perspective as well, they're now asking heightened accountability questions. And so regardless on what the perspective is on the term DEI and sort of how in favor or not it may be at any given point in time. Some of the investors are now going deeper to not just say, great, okay, tell me about how you invest in women or gender diverse individuals or minorities or any other equity deserving groups. But beyond that, what are you doing to create the right conditions for them to be successful? So tell me about what your policies are in terms of both the way you look at investments, but your own team around things like family leave. Tell me about what your flexible work policies are. And so the things that actually create an environment for those individuals to thrive in are things that they're asking for within their due diligence process to validate that you're not just talking the talk, but you actually are making meaningful decisions in that space. I think that we have greater transparency now across the ecosystem with some of those factors. And certainly to your point, I mean, it's almost, I think it's 20% now of businesses are women-led in Canada. And while there is a significant way for us to go in terms of women continuing to be the leaders of those larger scaled organizations that have significant revenue that they're bringing in as well, we've seen a really notable shift in terms of that ownership over the years. So being at 20%, there's still a lot of opportunity for us there, but it's a long way ahead of what it was even 5 years ago.
Amazing, thank you. And I have to say how encouraging it is to see that structural progress is happening. You know, you're mentioning new capital vehicles, that stronger accountability from investors, and of course, the increasing participation from women founders. Those shifts are expanding the pathways into capital, even as the broader market becomes more selective. But let's talk about the reality of where we're still behind. We have to talk about it. Women-founded companies still represent that small share of venture-backed founders. Equity rounds are smaller. Capital in growth gaps persist. Why? Emily, I'm going to pick on you again. Sorry. I would love for you to start.
My pleasure. And I think I'll lean off of a point that Courtney made just now, which was we're looking for that capital from women for women at scale, right? Women are leading companies, but are they leading companies at scale? And that plays back into this conversation around venture and growth capital, which is there are structural gaps. We can't just say everything is wonderful and because we're better than we were before, we should leave it as is and say we've done enough and move on to something else. Really, we need to look at how can we make sure that that venture capital is going across the spectrum to women founders so they're able to scale those companies. One factor really is that we've talked about is that venture capital has truly become more concentrated. The markets have tightened, and so investors are making fewer bets. That means that typically we see, and that's what the data over the last few quarters has shown, that they rely more heavily on using pattern recognition and investing in models and founders that resemble previous successes. And so if we look at historically where those successes have been in Canada, those patterns are not going to always or typically include a diverse set of founders. We're going to see that when deal volume shrinks, that means in turn that underrepresented founders are going to feel the impact disproportionately because if fewer investments are being made overall and they're reflective of what we've historically seen success in doing, that will not reflect them in that story. It's not to say that this is an intentional bias. I think it really is often a structural outcome of how risk is being assessed in concentrated markets. But the result of it is that the access disparities do continue to widen in these periods of capital discipline, and it becomes much harder for diverse founders to receive that capital and use that capital at scale.
Thanks, Emily. Over to you, Courtney.
Completely agree. And I think Ariel, maybe like you'll laugh at this because we talk about this in some of our bootcamp training that we go through, but pattern recognition is a huge element of it. And I don't know anybody who says, I don't invest in women or I don't invest in minorities. Maybe it's because I have a friend group and colleagues that, you know, are not of that opinion and wouldn't overtly make that statement. But most people that we engage with, it's not that they're not investing in these spaces because they have an overt bias against them. Rather, because of this concept of homophily, we tend to spend time with, we value the background of, we see that folks have a similar trajectory ahead of them when they have more similarities with us. So when they come, if they went to the same school that we went to, if they go to the same church that we go to, if our kids are at school together, if a prior colleague refers them, we tend to give their background a higher degree of credence and credibility, and we believe in the outcomes that they will achieve because we share those similarities with them. The challenge associated with that is when we don't meaningfully look to break out of the networks that we already have, or sort of these artificial boundaries that we already have, then we're not pulling in new means to drive innovation, and we're not discovering those really compelling, highly investable opportunities that are just outside of the purview and perhaps the worldview that we already have. And so it's not that people are intentionally necessarily setting up these barriers, but without a deliberate effort to seek outside of the spaces and the perspectives and the way that we find deals that already exist, we don't get a chance to tap into and pull out of that innovation. So, I mean, we have the density of networks that already exist. We tend to want to see prior institutional backing, and the institutions have likely found founders who are very similar to those that they have already funded. Or we want to see a degree of scale that they've already achieved because they've already been able to access that right capital and the right networks at the right time. And women have historically just had less access to those inputs, less access to those networks, and less access to that initial capital to drive that scale, which does become more challenging for them if we don't have an ecosystem and a set of investors who are trying to break outside of those boundaries.
And that's the reality we're seeing. And so thank you both for sharing those insights. Let's talk about investor expectations in a disciplined market. So my question for the two of you, Courtney, let's start with you this time. How have investor expectations changed? And what does that mean specifically for women founders?
So I would say, to be honest, they haven't changed. It's just when you are in a frothy or FOMO-driven market, investors' real focus and adherence to those same principles sometimes can flex a little bit because there's capital going around spare, and it is like investors get FOMO off of each other, so they'll want to be included in these deals, and perhaps they soften the rigor that always should have been applied to investment decisions. When we're in a market like we are now, where there's less capital that's going around to spare, we have to be exceptionally judicious about where we are making those bets. And so there needs to be the clear pathway to profitability that always has been the case. There needs to be the right level of governance and a willingness to build out those governance structures, I think, at the right point and right time as well. I would say what has changed, though, to an extent, is the focus on capital efficiency. And the proliferation of AI has been certainly a component of that. It's something that we see, to make a very broad statement, that women founders tend to do really well anyways, is that they're exceptionally efficient with the capital that they have because they don't have as much available. They are very laser focused on driving profitability off the hop and managing that. But nowadays, with the availability to do so much more by enabling AI across your organization, if you don't have a perspective on the way that AI will be applied to drive that capital efficiency early, you are behind and you're going to miss out, and you will be kind of you'll be missing the mark in investors' eyes. There is, especially in markets like this, I would say, greater scrutiny and an expectation that the CEO knows immediately what their cash burn is and what the levers are for them to adjust should they need to. So if their funding is delayed, if their revenue targets are off, they need to be able to answer the question, and they always should have been able to, but they do need to be able to answer the question about what their cash runway looks like and what means are for them to adjust that. They need to understand foundationally their unit economics. Again, that has always been the case, but particularly in an environment like there is today, that's of significant focus. And then I would also understand the reality of diligence cycles and what those look like. So fundraising, I think can be the bane of any founder's existence. Certainly, it is the full-time job that can distract them from their full-time job of running the business. But when we have sort of an ecosystem environment like it is today, you need to factor in the timelines to do that into your financial planning, and you need to be understanding of and open to the degree of diligence that's going to happen when the market is like it is today.
Great, thanks, Courtney, and a lot of great insights for women founders to take away, or any founder to take away, of how to improve their fundraising process. Over to you, Emily. I'm curious, as an ecosystem leader, what are you seeing when it comes to investor expectations changing, and what does that mean for women founders specifically?
Yeah, I think from what Courtney said, and completely agree and resonate, what I'm hearing from investors and getting in terms of feedback around founders is they want to know that founders know those numbers. So it's very important that founders show up confident and ready, not just to have hired someone to build that financial model for them and slap it in a deck, but they can actually speak to their numbers on a regular basis, that they can articulate what assumptions have been made when they're doing those types of things, to really showcase that they are really operationally disciplined, that they are aware of the financial circumstances of their business, as well as how their growth plans play into that, and what that means for them in terms of what this capital that they're seeking will release. I'm hearing more and more from investors, we like the business concept, but we're struggling to find conviction that they have a growth path, or that we are struggling to see how they're going to expand into major markets. And it's not because these founders can't do it, but it's because of this, lean into not being able to per se articulate those different elements that they're doing around the business, the operational side of the business, but rather to have leaned into one or two really great metrics that they've seen, and push those really hard in the story. I think what women founders are especially great at and should lean into, like Courtney said, is being really financially responsible when it comes to business building, being very capital efficient. That's true of all Canadian founders, historically far more capital efficient than our neighbors to the south. And for women, the growth rates on profitability, those things are there, those are being articulated. And additionally, the actual structuring and the building of your company and that culture, the data shows that women founders are exceptionally good at that. They're exceptionally good at building culture that sticks, building teams that grow into their roles and succeed in those spaces. How can we articulate these things to investors to sell them a compelling narrative, not only that maybe you ran some kind of campaign that got great organic traction, and would have been peak hype of 2021, but wouldn't show today that you're going to be able to continue that's something that's a scalable path forward. Lean into those skills, lean into your perceived spaces of excellence, and where you feel that you are most compellingly leading those companies when you're telling these stories, but making sure that you're showcasing the numbers, you're showcasing the base. It's not enough to have a cool idea anymore or have some sort of viral moment. It's important to really showcase this is a business that lasts and you're an enduring founder of that business.
Great, I appreciate that insight. I keep hearing operational discipline, where investors are prioritizing those fundamentals, governance, financial clarity, so knowing your numbers and knowing them well, the clear economics, and to have that disciplined growth strategy to better attract capital. So that leads me to my next question. Where do we see the most persistent scale-up gaps if that's the case? Emily, can we start with you?
Yeah, I think it's persistent at the growth stage of capital. We have seen, which is wonderful, early stage access having improved in recent years. I talked about there being more funds focused on women founders. We've seen new state seed and early stage venture funds entering into the market. But when we look at the large venture rounds and when we look at the private equity transactions, participation by women-founded companies is still much more limited. It's significant. And so the issue now isn't just about getting the first check. I know in 2018, I was talking a lot about how we couldn't get those first checks in, and so there was no chance. Of course, we would like to see more checks being written. We'd like to see more early stage capital. So we're taking it from that 20% up to a more appropriate number of nearly half the businesses growing and being founded, in my opinion. But it needs to be that there is also follow-on capital available and that there is ability for these founders who are usually taking a risk and leaving great jobs and fulfilling careers to build something, to have the ability to scale that over time, and especially to have that ability to scale it over time as Canadians. And so I think that's where strengthening our capital ecosystem, particularly around the growth stage financing component, has to become really important to us.
Great. So from an investor perspective, Courtney, do you agree? What do you see?
Yeah, I mean, especially the drive to really harness Canadian-led innovation and to be funding that as a material part of our growing economy has been certainly a theme of discussion that I've heard. We've been doing this national series of events across Vancouver to Toronto, Montreal, and that has certainly been a really similar theme, is that people are looking to allocate their capital now specifically to support and drive Canadian productivity and GDP growth. But what has been a gap, certainly, that's been noted in those conversations is that growth stage capital is very challenging to access in Canada. It continues to be so. So there might be the first couple of checks that, we have an increased number of early stage funds, particularly that are investing in women. And so that is available and it is accessible. And then on the other side of the spectrum, we have these massive pension funds and deployers of capital that can't write a check that are less than $100 million in size. And so getting between that early stage and that really massive scale continues to be a challenge. And that is where we see a lot of founders being driven south of the border to access the right stage of that scale. So I will say that continues certainly to be a constraint. Companies, though, once they do write that first check funds, when they've written that first check, they are reserving a component of their available capital to do the follow-on rounds. So they are going to have to actively manage the portfolio and pick what they think are the most likely to be the winners within that, and then provide that follow-on capital. But they also play a role in securing other investors to come in and syndicate and help close out those rounds as well. So, as you do get the first checks in, certainly lean on the funds or the angels or whoever it is that are investing in you to help be planning ahead and securing the next stage of capital to come into.
It's an interesting reality. So while early stage access has improved, the real challenge that we're seeing is scaling. So growth capital is tighter. Funds are reserving for their existing portfolios, like you mentioned, and there's fewer entry points for founders looking to make the leap from early traction to that large scale. So let's get into some strategy here and some solutions. How should women founders position themselves strategically, knowing all of this? Courtney, can we start with you, please?
I do think there's a degree of forward thinking and sophistication around the strategy, which shows really well early on. If you can demonstrate that you're connecting the dots and you are a founder who's able to take in multiple perspectives and opinions at the same time and stay obsessed with the problem that you're solving, but not married to the solution that you have today, it's very important to be able to demonstrate that perspective off the hop. It's something that we certainly look for in the founders that we invest in, is that they're coachable, in that they really, really care about driving towards the outcomes that they believe their current solution will provide, but they know that it's a meandering journey to find product market fit, and they're going to be willing to do what it takes to iterate along the way. So I would say obsession with the problem, but an aptitude to be receptive to coaching and feedback is an important one. And I would say as well, it doesn't matter if you're a male or a female founder, that is everyone. I would say the second piece, and we've kind of touched on this a little bit, but it is the forward thinking, and again, the willingness to put in the right governance structures at the right point in time. So you want that early board of advisors around you to be providing that feedback. And then as you grow and mature, you are actually looking forward to the level of governance and sophistication, and you're willing to put those structures in, not as it being sort of in competition with your role or leadership as a founder, but as a demonstration that you are running a tight ship, that you are prudently managing the funds that you have received from investors, and that you are going to be communicating success and risks with them in a transparent and forward-looking manner. So part of the benefit of having the right governance structures in as well is that they have a sense of confidence that they're not going to get an email from you that says, payroll's due in 3 days, we can't make it, but that you're actually giving them the right warning signs so that they can help you adapt to make the business successful as well. For women in particular, I would say that it's really critical both to be looking ahead about the relationships you will want to have in place ahead of your next raise. So you're building the early relationships with the funders out there, and kind of syndicating the relationships with you that you have to provide that wraparound ability. But more than just looking at the financial capital that would be fruitful, be looking at the human capital that you can leverage to really drive your business to success as well. So I would say we see, again, a very broad generalization, but women are amazing about building community around them. And one really unique kind of superpower that they can exercise out of it is not just looking at that community as a source of checks, but what more they can do to be champions and advocates of your business and help propel sales relationships out of it, help propel partnership opportunities. And so, yes, like look for the strategic financing, look at what your acquisition strategies could look like, look at blended capital, but also look at the human capital that's available around you and how you can harness that for your business.
Absolutely. Really utilize your network as much as you can. That's great advice for founders. I would love to send it over to Emily for advice. How can women founders position themselves strategically?
Yeah, absolutely. I think what Courtney has shared is so important and largely, and I think almost totally, is relevant to all founders, not just women founders. I think when we talk to women founders, it's about, in my opinion, them really reflecting on some of these elements and how they apply them. So what we often see different is not that women don't have advisors, but then sometimes women latch on to advisors as needing to be so important that they bring on too many advisors versus the right advisors, or giving up too much equity to advisors instead of structuring advisory roles in the early stage in a reasonable way. And doing that can sometimes challenge the fundability of your business if you've given up too much equity before you've really, started to knock on that scaling door. So doing those things when it comes to it, again, it's not like Courtney said about worrying, or that you shouldn't worry that it's about knocking into the space of your role or containerizing you, but rather that you have the support, you have the network to do that. And it showcase your willingness to do this showcases that you're building something that is much bigger than you. You as the founder can't be that person who's going to make every single decision and be in every single conversation and have the advice every single time, because you're building something that goes far beyond your experiential realm as a person, as it would for any of us. So really making sure for women that we're being strategic about how we deploy these activities, how we're being very careful and also trying to approach with confidence how we speak about the operational strength of the business, of the financing and the structuring of our businesses, because that coachability is so important. And to showcase that you are coachable and that you have a durable plan in mind, that you can intake all of this feedback, you can use it to continue to navigate forward waters, while also making sure that you're keeping that North Star and that goal in mind. Really important to show up confidently and make sure that people know that you have a plan, that you are the person to action that plan. And it's not just a good business, but that you are the right founder and a great founder for that business. Making sure that you're staying centered in the conversation around fundraising, I think, is especially important for women founders in this time where it's not about the excitement of or FOMO opportunity. It's really about building meaningful and repeatable business.
I love that, Emily. And what I'm hearing is with founders, preparation positioning matters so much. Really demonstrating that operational strength and having the conviction that you are the right person in the room. I'm seeing that we have some investors in the room today. Great to see some familiar faces. My next question is for them. For investors, what should be considered in this recalibrated market? Emily, over to you.
Yes, I'm sure Courtney has far more to say on this than me, so I'll try to keep it short. But from an investor perspective, we know that disciplined markets are often historically having created strong vintage opportunities. So when underwriting standards rise and diligence improves, the companies typically that are receiving capital are seen to be more resilient and are fundamentally strong companies. But at the same time, it's really important, I think, that today's investors remember and reflect on the fact that women-led ventures remain a significantly underleveraged opportunity set. If we look at their participation in companies, how they build companies, the outcomes of those companies, great success. The numbers released by BDC in terms of 4x return for average on investors and 2x on their revenue and growth comparative to the general population set shows that they're building strong companies. On average, it's a great investment opportunity. But based on what we've talked about in terms of how many checks are being written, it's still significantly underleveraged, and there's enormous opportunity to sweep up investments and space and equity in those companies. If we look at how we can do this, it's going to be right now a meaningful gap, but I think in the future could mean that we have even stronger vintages than we've had in past terms. Being able to look for compelling investment opportunities outside of our typical pattern recognition is really important as the landscape continues to change more and more.
I love that and gives me great hope for innovation and diversity in portfolios. Courtney, what about you? What should be considered in this market?
So everything Emily said, 100%. I mean, we invest in women because they are an undercapitalized and outperforming asset class. That is why it is the foundation of the thesis of where we invest. It's not because of the inherent social good that's caused there, but it's because there is white space and there is an opportunity that is largely uncontested or has historically been uncontested because the networks don't exist and people just aren't searching for innovation there. So as investors are writing fewer, more disciplined checks, the only thing I would add is that the challenge for each of us, I think, to take away is to say, where don't we have the relationships and networks right now? And how can I meaningfully go out and discover opportunities that are in that space and not wait for them to come to me, not anticipate that they're going to come to me as a warm referral because they may not have the same network density and connectivity that you have. And so how can you go out and make a meaningful effort to find that, particularly as I said, the checks that you're writing are going to come fewer and further between. I think investors in the market like this, certainly they temper their own FOMO. So again, they focus on the foundations, of which I would say the female founders that we often engage with are so well versed in because the bar is that much higher to even have a seat at the table, to have a conversation with you, to pitch. The last thing I would just add is, especially considering in environments like this, and even in frothy markets when there's a ton of capital availability as well, considering what you as an investor can bring to the table beyond the check. And so what sales pathways can you open up? What meaningful resources can you provide for founders, not only within the context of their company scaling, but supporting them as a human throughout this remarkably challenging process that they go through? Founders are the most fascinating, most driven, most slightly insane for doing what they do people that we encounter all the time. But I would just challenge investors to look at them not only as the check that they're writing to the business, but the humans that you are providing backing to. What other support systems could be valuable around them to really make sure that they can not only survive, but thrive through these stages of scaling?
That's great, Courtney. Really showing that investors have that opportunity to expand their networks and identify those high-performing founders who may have been historically often overlooked. There's so much opportunity within that. I'm also seeing here in the room there is ecosystem leaders and policymakers. So this next question is for them. What should be considered for them in this recalibrated market? Sorry, Emily, I'm going to pick on you again. I would love to hear from you.
Yeah, I mean, I spoke about it a little bit earlier, but I do think it's important we recognize how much progress has been made here. We've seen expansion in early stage access to capital. We've seen new capital tools to market. We've seen more entry points for women founders to build companies than we've ever had before, from federal initiatives, provincial initiatives, and local ecosystem initiatives. It's all helped women founders to gain more access to this pathway and to build meaningful businesses for the country. And I think at Movement51, we see that every single day in our work. There's more founders starting companies and entering the capital pipeline than we've seen in years. And since pre-pandemic times, there has not been a time in Movement's life that we have seen as many companies coming through our doors, knocking on our doors, looking for help and looking to scale than ever before. And where I think that means we need to go when it comes to policy and ecosystem is what are we doing once those companies start to format or formalize and they start to gain that traction? Because it's very important in my mind that we address the challenge of creating clear pathways for that early traction to scale. And so whether that's making sure we have capital available for larger venture rounds, whether that's growth equity, whether that's us focusing on supporting the commercialization, introductions to new customers, to new buyers, making sure that our companies are not early formers and dying off before they're scaling. Because if we want to see Canada become a place where we can build meaningfully and repeatably large and globally competitive firms, the ecosystem needs to support founders from the start, and the ecosystem needs to support diverse founders because that is one of Canada's greatest skills when it comes to what we can do to differentiate ourselves from other markets in building these kinds of firms. And so it's really that phase of growth I think we need to focus on now, making sure that we are strengthening that scaling pathway, that we're creating connectivity amongst our ecosystem members, that we're putting in the focus, the effort, the energy, our networks and our connections and our capital into making sure that scaling is possible so that we can level up this progress that we've made at the early stage.
Great. Thanks, Emily. And I love that you brought the Canadian nation pride forward. It's important that we celebrate what makes us different. Courtney, what advice would you give to these leaders in the ecosystem as well as the policymakers?
Yeah, so I think building, Emily, on your comment about driving that diversity, continuing to enhance the transparency into the data that exists today is one meaningful step. I think the more that we know about where capital is or is not flowing allows us to make well-informed decisions about the ways that we open up those access pathways. I would say that there's a really important opportunity to both unlock the institutional capital that could be made available, but also the individual capital that could be made available. So at the 51, we started selling entirely to individuals from a fund perspective, and people thought that was somewhat insane. And some days I agree with that. Just the level, the number of LPs that we have relative to AUM is significant, and that was a deliberate decision because we wanted to open up more opportunity for individuals to say, I believe in this. I believe in the outcomes that you're going to drive with this, and I believe I'm going to get a great return out of it, and I'm going to put my dollars in there. And there are policy and structural decisions that will continue to incentivize that. That can be things like tax credits that will be made available. It can be incentives for early stage investing, certainly. And so I think anything that is available to us to continue to drive people one by one to fuel Canadian innovation with their discretionary capital is a meaningful opportunity. Also supports that larger institutional funders can provide to emerging GPs also makes a material difference. So similar to the fact that it's hard for first-time founders to go out and raise capital for their businesses, it's hard for first-time or second-time or even third-time fund managers to go out and raise capital into their funds because they have not necessarily been around for long enough that they've had distributions to go back to their LPs. And they, similar to how an investor will want to know the track record of a founder, they will want to know the track record of a fund. And so without providing emerging manager supports, the challenge is that we have fewer and fewer new funds being created and fewer funds then deploying capital into diverse founders that exist out there as well. So there's a couple of meaningful options, I think, from a policy perspective to do so. And then certainly from an ecosystem perspective in general, I mean, just continuing to provide funding for educational programming, both for new and for scaling founders. I don't say that purely as a plug for Movement51, but it is a really, really meaningful way to support the founders in that journey and to shorten the timelines for them to raise the capital that they need to scale, and then also make sure that they are scaling in as quick and efficient a manner as possible.
Thanks, Courtney. And exactly like what you're saying is the entire ecosystem, we all have a responsibility and we have all opportunity to support these founders. And really loved the examples that the two of you provided. So that's a wrap. The question isn't whether capital exists, it's who is positioned to access it and how the ecosystem ensures that this opportunity scales equitably. So thank you all for joining us. It was great to be here. We're going to move over to Amy to moderate the Q&A. I see we've got 8 more minutes.
Perfect. Thanks so much. We do have a couple questions in. A quick reminder to all of our folks on the line that if you do have any questions, feel free to pop them in. We'll start off with our first one here. Are there provincial or federal government tools or regulations that you think should or potentially could change to support early or longer term investors, investor tax credits given as an example?
Yeah, I can provide an early thought on that. Certainly, there have been kind of opportunities that have been experimented with in various formats across provinces in the past. The thing I would note is that regulations are not consistent province to province. So we each have our own provincial authority that has a degree of regulation around what raising venture capital looks like. But in Manitoba, Ariel and I, we were out there last year just as they were announcing this, but they have a significant tax credit which incentivizes individuals to invest in venture capital, which does, if you're going to make a decision to invest, say, in a VC fund already, it makes it that much easier. It sweetens the deal. It goes a fairly long way in terms of removing the barriers that individuals face in making that kind of high risk decision. And then the other item I would suggest, something that Alberta has been exploring, is today venture investment is generally limited to accredited investors. If anybody doesn't know what that means, this is something that we talk about and teach at Movement51, but it really is an asset or income test that says, I make X amount of dollars a year, or I have this much in assets, so that if I lose everything on this investment, I will not have lost my shirt, rather. Like, it is just a way to say you should be able to absorb the risk of losing your investment in this high risk space. But they have expanded ways for others to participate, not only being an accredited investor, but you could be an eligible investor, or there's other terminology for it that says, I have sufficient educational background or knowledge of this space, meaning I understand what the risk is, and I don't have to be, a well-established millionaire already to put my capital in this space. So certainly I would say that those kind of programs, removing any of the barriers to widen the net for who can participate, does make a really meaningful difference.
Fantastic. Thank you. On to our second question. Does there appear to be a pattern in the types of businesses that get backing? Some of the examples provided include engineering, architecture, manufacturing, transportation, and several more.
I think this is and Courtney, feel free to also jump in here. I think this is a difficult question to ask because it really depends on what kind of backing we're talking about. Like, if we're talking about venture backing, then it has a lot to do with the scalability of that business. So any of these fields, I have seen great investments being made by Canadian venture firms into companies that do manufacturing, transportation, healthcare. But the component of what makes it different isn't, we are a manufacturing facility and we are going to produce more steel components. It's that we're building a tool for manufacturing to become more efficient, or in order to better manage the workforce within manufacturing. It's more so about how can we scale and tool different industries, or how can we build tools that will allow these industries to grow and to succeed at scale, so that when the money is being invested, the amount of customers, the size of market, how much can be reached as possible. If your business requires it to be kind of, you have 10 customers, for every 10 customers, you then need to bring on a new consultant or a new support person, the scalability of that is far more difficult. And so those types of things don't make as much sense in venture, but there are lots of private investors that are very interested in traditional business. I mentioned very briefly, but there is more and more popularity in entrepreneurship through acquisition in general. And so, how can we become investors or entrepreneurs by acquiring a business, by investing in an existing business and looking at ways to often modernize those businesses? Can we take a new approach to building those businesses? So, the pattern is more around, are businesses efficient? Are they solving compelling problems? Do they have meaningful traction? Than it is to say, right now it makes all the investments are in healthcare. I would say what you see in the news, though, is something that people keep an eye on, right? We talk about AI. It was a lot of companies I know that were doing early AI 10 years ago. It was not the selling feature of their business. And now a lot of people have, in my opinion, erroneously, we could go down a whole path on that, so I'll refrain, but started saying that their main business is AI because there's a lot of excitement around reviewing businesses where they see that scalability and that potential. Defense is another one. We hear that every day in the news, right? So there are trends. It is following along with the economy, but it's not to say you should build one specific kind of business or that only certain kinds are getting funded right now.
I completely agree with that, Emily. And the only thing I would add on top of that is just know when you're going to go out and pitch for funding, do the exploratory work first to just confirm that you're even a part of their thesis. So you will save yourself a lot of time. There are investors that are seeking to invest in each of those areas, but make sure you're going to the right folks to begin with so that you're not wasting the time and effort on that conversation if you're never going to be a fit for them.
Perfect. Thank you. And we do have lots of great questions coming in the chat. Unfortunately, though, we've only got 2 minutes left. So I'm going to squeeze in what seems like the easiest one to answer here. Are you seeing capital available for startups that are in an R&D phase?
It's a good question. I mean, I think it depends on R&D for what outcome. So generally, yes. I mean, certainly the funding timelines and horizons for things like pharma and biotech, they're very different. And yes, there will be funding made available for that. But the right demonstration and milestones to show traction can look different depending on the type of R&D that you're doing. And it's not that every investor will be looking for the commercial milestones like revenue and customer signups and that sort of thing out of it. But depending on the space that they're investing in, they will have just different expectations of the right milestones that you get to along that R&D pathway.
Fantastic. Thank you so much. And with that, we are just about out of time. So I'm going to take our last few seconds just to say that on behalf of Alberta Innovates, Courtney, Emily, Ariel, thank you so much for sharing your day with us and, of course, these valuable insights. And I'd also like to extend a thank you to everyone else who joined us for the call. I hope that you got as much out of this as we did. So thank you so much. And I hope you enjoy the rest of your Wednesday.
Thank you.
Thanks for having us.